Welcome to this webinar, a joint webinar between Fair4All Finance and Campbell Tickell, in which we're focusing on building partnership working between housing associations and community finance providers. And today, following this event, the report, which we've worked on jointly, will be launched, and everybody attending will be able to access copies, and they will also be going out more widely on social media and through a range of different channels. It's good to see a really positive attendance. We're already over 100 people here, which is an indication of the level of interest in this subject. Before I go into the details of the event, I mean, I would say that I think this publication is timely for two particular reasons. Firstly, while we're seeing a degree of recovery across the country from the worst of the economic ravages that we've all experienced over the past year and a half, that recovery is lumpy and uneven, and we're seeing poverty increase in many areas and sectors, not least with the ending of furlough, the winding down of the universal credit uplift, inflation increasing, energy prices spiraling, and so on. So clearly that pressure is going to be felt by a great many people in different parts of the country, and the reality is that many of them will be looking for credit to get them over particular temporary problems or to deal with life challenges and so forth. And secondly, the other reason why I think this is particularly timely is because as far as many of us are concerned, the kind of partnership working that we've seen over the pandemic, in many cases cross-sector between housing organisations, health, social care, local government, community organisations, and others. I believe that's one of the big takeaways from the pandemic experience, and something we have an opportunity to build on. Now, we have a number of speakers with us today. Two of us are in the same office, others are in different places. We have Ria Bales from Fair4All Finance, Maggie Rafalowicz from Campbell Tickell, Stephanie Noyce from Clarion Futures, James Wilkinson from Fair4You, and Lauren Peel from Fair4All Finance. And you're going to be hearing from all of those in the next few minutes. As you'll have seen on the way in, we will be recording the webinar. The recording will be made available soon after the event to those who've attended. We're on a tight time scale, so I hope you'll bear with us around various of the arrangements. The chat function is turned off. Please use the Q&A function. We'll monitor as we go along. There'll be an opportunity after the speakers have done their presentations for addressing various questions raised by people attending. You will be able to like or upvote particular questions that others have posted there, which will indicate to us if it's a popular topic that people would like answered. And you'll also be able to comment on questions raised by others. There is no, apart from the chat function, you will be on mute. There's no video function for attendees, but you should hopefully be able to see all of the panel. We will do our best to answer all of your questions, but realistically, with the sort of attendance numbers that we've got here, it's not going to be possible to go through all of them. But please email us after the event if there's anything you'd like to follow up on. The best email to use is events@campbelltickell.com. Now, before I hand over to the speakers, we would like to put two polls to you. Those will be appearing shortly, and please vote in each of those. Poll number 1 is asking whether your organisation is actually currently involved in any partnership working between housing providers and affordable lenders. Unsurprisingly, you'll have two choices there, yes or no. And poll number 2 is going to be asking, what do you think is the biggest challenge to establishing successful partnerships between affordable lenders and housing providers? And you'll have a choice of four options there. So those polls will be appearing very short. There's the first poll now. Please vote. We will see and post the results as soon as we've got reasonable numbers. And it says that the host and panelists cannot vote. So there's no fixing of the answers. While the polls are going on, and being conscious of the time scale, I'd like to move on to our first speaker. So I'd like to welcome Ria Bales. Ria has been a non-executive director of Fair4All Finance for the past year and a half. She's a consultant in change and transformation, and she was previously group director of people and change at One Housing Group. Ria, over to you to set out the context and the
Wonderful. Need. Thank you, Greg. Thank you so much. And I'm just overwhelmed. It's absolutely brilliant to see so many people here joining us. So thank you to all of you who have given up a bit of time to come and listen to us. And hopefully you're preparing your questions for us as well for the panel too. So Greg did a lovely introduction. My name's Ria Bales. I'm a non-exec director for Fair4All Finance. I've been working in or around the social housing sector for probably about 12 years or so now. And I've spent a fair bit of time working around kind of social mobility. I think it's really important for us to recognise that housing associations are a real cornerstone in the community, not just through the provision, of course, of affordable housing, but also the placemaking and the wider role that they play in communities too. I decided that I wanted to join Fair4All Finance as a non-exec director because I saw the overlap between the sectors and the common goals that we all share. Let me maybe just paint you a bit of a picture and give you a bit of a flavour of why I think this is so important. I've spent time working with residents, either helping into work or improving kind of working position as well. I've seen a lot of effects of in-work poverty. I've also been part of running the UK's largest mixed homelessness hostel as well in London. And I've seen the never-ending barriers to people just being able to get a chance. Now, the amount of people that are accessing high-cost credit in the UK is, it is just eye-watering. And Fair4All's challenge is to increase access to fair financial products and services to help people in vulnerable circumstances meet their day-to-day financial needs. And it's really important, I think, it's necessary to absorb the shocks that people just experience in life and to smooth incomes as well. So financial well-being and resilience, we know, is so important. We know that social housing tenants tend to have lower financial resilience. And many of us, I think, will have seen here the complex and vulnerable circumstances in which people live, the difficult choices, I think, that people are having to make every single day. And Greg set out a bit in that kind of thing, the effects of COVID have only made this a lot harder. Cutbacks in public service funding, in services, in a kind of all that public sector involvement, as well as making this environment incredibly difficult for people. And I think, those of you here will certainly have seen the effects that our economy, our politics, our societal attitudes, that, you will have seen the effects that they have on people every single day. And I think without that financial resilience, we know that choices become more limited, they become more difficult. And they quite often, the effects of choices become more long-term as well in terms of their impacts. We know that 80% of social housing tenants have no savings at all. 17% of social renters are living without some sort of essential item. And by that, I mean a washing machine, a cooker, a fridge, a freezer. Just imagine living your life without these essential items, let alone also having to provide care, which a lot of people are doing either at each end of the spectrum, either to children or to older people in the families as well. And of course, this leads to the poverty premium. Yet those people who really need a break the most are actually the ones that are having to pay through the nose because of risk pricing, uncertainty, lack of access to cash, all of these things that are coming together, which are just making more and more barriers and making it more and more difficult. But of course, it gets even worse. Social renters, they're disproportionately likely to be in debt, particularly, and this is where it becomes quite scary, to high cost payday or doorstep lenders. And they're at greater risk of being victims of loan sharks. And when I saw, I think it's heartbreaking when you see these numbers. 62% of citizens advice debt advice clients who owed money to doorstop lenders in the social rented sector. 45% of loan shark victims that were helped by England's illegal money lending team were social housing tenants. I mean, this shows you the picture, I think, of, of kind of customers and people that we are all kind of dealing with, the overlap, and as I said, those common goals here. Now, we'll hear from Stephanie at Clarion, but I think also our friends from Peabody found at the start of the year that 1 in 4 of their tenants reported being in desperate financial straits, with many having utility or credit card debts of over £1,000. And I think, we've got empathy. We can see how unfair this picture is that I've painted, but it also has an impact on our businesses. Rent arrears have increased substantially during COVID. I think 30% between March 2020 and the beginning of this year. And they've topped £1 billion for the first time. So I think, it makes really, really clear sense for me for housing associations to work alongside affordable credit providers of this similar type of customer base. I think it's really important to support a greater reach and therefore actually trying to help more people access affordable credit rather than turn to those high cost credit providers. And I know I'm not saying that this is not happening. Housing associations have already got some great partnership work going on. They're already offering a wide range of support around financial well-being. We see lots of things around employment services, saving plans, signposting to various other partnerships and stuff. But we think that access to affordable credit should really be considered as a very important part of this offer. Let me just touch on one of the barriers that I certainly have seen over the years around this. And I think it's worth just kind of exploring this or highlighting it. I think there is still a myth around housing associations not being able to talk anything finance to residents. But the FCA and the government have included specific exclusions allowing social housing providers to refer tenants to credit unions and CDFIs, community development finance institutions, without the need for FCA authorization. And I think the more that we can get that out there, so the more that actually housing associations can feel comfortable doing this, then I think that's great, because it means that partnerships can be entered into with much greater confidence. So affordable credit, we know, can help financial resilience. I don't think that we should believe that there is, such a lovely world that actually people don't need credit. Of course, people do need credit, and affordable credit is what we are saying that people should be able to access, fair, affordable financial products. It allows people to meet those unexpected needs, those real emergency costs and such, without taking on that unaffordable debt that only causes financial problems to spiral. Very, very slippery slopes, which I'm sure many of us have seen kind of the effects and the outcomes of those. So I'm gonna pause and kind of leave it there. I'm really looking forward to hearing from kind of Stephanie, Jones, Lauren, who are really at the forefront of this, and I think are going to bring it to life much, much more. So thank you so much.
Thank you very much, Ria, for that fairly stark and direct and indeed heartfelt explanation of the need for this kind of work. I'm going to hand straight over to Maggie Rafalowicz, who will talk through some of the key messages from the report. Maggie is a director at Campbell, Tickell, has been for the last 10 years, was previously Chief Housing Officer at Brent Council, and she led the Campbell Tickell project team on this work with Fair4All. Maggie.
Okay, great. Thanks, Greg. Let me just move over there so I've got the screen all to myself. Okay, first of all, Ria, thanks very much for doing that introduction. I don't think I could have done it any more passionately than Ria did. But I think actually from my work with, over the last however many years working in sort of social housing and housing strategies across the country, you can actually really understand the need for and sort of the poverty that some tenants are actually facing. So what we're going to do is I'm just going to give you, because we've got a number of people speaking, just a few insights from the report that we did. So, if you can go to the next page, please. Right, just to let you know what we did. I mean, we started this actually quite a while ago, but COVID got in the way that we were working. But we started off by doing some desktop research, because actually people have been involved in this, affordable credit for a very long time. So we did some research. We then carried out a structured survey of housing associations, and we got results back from about 52 associations that cover about 16% of the stock in England. We then also did some interviews with housing associations, with credit unions, with CDFIs, debt advice charities, etc., to really get a good feel for it. We had roundtable discussions with lenders and with landlords. We had several groups of those. And we were also able to have some one-to-one sort of confidential discussions with tenants. And we were sort of, you know, some of the housing associations gave us introductions to tenants, and this was completely confidential. We clarified the regulatory position, and I've got a slide for that. So Ria, we're going to re-emphasize the point we made. And then we also, in the report, you'll see a sort of a guide to setting up the partnerships between associations and CFPs. Now, CFP stands for Community Finance Provider. That's the terminology I'm going to be using. So just another new acronym for us to have. Next slide, please, Zena. I think one of the things we did notice, and Ria made the point very strongly, is there is a kind of reluctance or misunderstanding about what housing associations can actually do in terms of credit. So we did actually check the position, and we knew it, but we wanted to make it absolutely clear. The social housing providers can refer tenants to credit unions and CDFIs. They don't need the FCA authorization. There is a guidance note, FG 18/6, that you can actually look at it. You don't need authorization as long as you don't charge a fee for that introduction. So you don't need authorization. And then indeed, there is a specialist team that can answer questions. So if you actually want to approach the FCA, there's the email that you can actually use. So that's to make it absolutely clear. Right. When we were talking to associations, and we had a lot of interviews, etc., we came up with sort of different types of partnership types. So there are different ways that associations are dealing with credit unions and CDF and community finance providers. The very simple one is that you have a referral, very limited targeting. It's offered in sort of a blanket fashion to all your tenants, or maybe to those who approach you for some help. Then there is actually when you have a referral, but you're actually targeting the housing association actually identifies tenants that it wants to go to and proactively makes the contact and encourages a tenant to apply. And there's a case study in the report from Lewisham Plus Credit Union, which you can read up on. There's also the case where actually the housing association will underwrite the loans given. So the housing association will refer the tenants, underwrites the loan, that reduces the risk to the lender and increases access for the tenants. There is a case study in the report from BPHA and Bedford Credit Union, and it's been very successful. And I think all the loans haven't been any bad debts, but there are very few of them. So you can learn more about that. Then actually there's the loans, but you link it to the wider financial support. Now we know that housing associations do a lot of work with tenants, including sort of financial support and things like that, and advice. One example of this was Hyde, that during the COVID, it discovered tenants, or not discovered, all of a sudden tenants who had never had arrears before were having arrears, and it wanted to support them through alongside the financial supports, their own financial support services. So, and that's, I think with the time that I spoke to Hyde, they had about nearly 200 tenants that they were supporting. They expected that the loans would be given back over a 2-year period. And it's actually made sense for the association as well, because all the time and effort that association officers actually spend with the tenants would be saved if you could actually help them in this way. Next one. Now, this is where the affordable CFP would provide loans and financial support. So the housing association would advertise the service and actually signpost the tenants with support needed. In some ways, it's sort of like, rather than having an in-house financial service or financial support for the tenants, it sort of outsources it to the CFP. And there's a case study with NG Homes and Scotcash in Scotland about that. Then, of course, there is, when Ria mentioned the fact that people don't have white goods, things happen, they need household essentials. And And that often is actually one of the main reasons why, there was a quote from one of the tenants in the report saying she has 7 children, she needs a washing machine. If it broke down, you've got to get one. So this is where the housing association might advertise a scheme where tenants can apply for loans, and the CFP will provide access to a range of decent quality homes. I think James might be touching on that a bit more. There's also a case study about Barnett Homes and Fair for You. And then there is, when an association is big enough, it could actually provide loans across multiple geographic areas. So if you, and the case study we've got is Clarion. And to be perfectly honest, if Clarion operates all over the country, but it's got a relationship with Leeds Credit Union, it's much easier to do, and Stephanie will speak about that as well. And finally, it's not just the tenants that housing associations can help, it can also be their employees. And maybe Steph can touch on that as well. And the final slide for me. Oops, no, back. Okay. So we were looking actually, what does make a successful partnership? Well, first of all, you need commitment from all stakeholders and at all levels, from the board members down to the staff. Sometimes officers, we found, are really reluctant to point the tenants in the direction of getting even more credit. It seems kind of perverse in a way. But in actual fact, what we found is that tenants will be going out, they need the money, and they will be going out to all the kind of loan sharks that are out there because they absolutely have to have it. So by helping them go to an affordable credit lender, you can actually get them, the rates are much lower, and it's a much more safe environment to do that. Second thing, when you do it, it's like any project, you've got to plan it. You've got to have your success criteria, you've got to have your responsibilities, you need to know who's making the decision, when, you need to be able to review it. So approach it like you would approach a proper partnership. You need to promote it with tenants and staff. I mean, and also do some signposting. We did some mystery shopping, and we also looked at the web pages of associations. And sometimes it can be a bit of a mystery how to get to the help that you need. So promoting it and signposting it well is very important. Now, early engagement, trying to identify the tenants before the problems intensify. We have a lot of data now that we can use. And actually, Ria referred to Peabody, but I remember Brenda Sarsfield, who was then the chief exec of Peabody. So in actual fact, they know more about their stock than they know about their tenants. And if one thing happened from COVID, I think tenants have been actively engaged and contacted much more than ever before. We should continue that. We need to do that. We can tell if someone who has never missed a rent payment, all of a sudden has missed one. That's the thing. People are, when they're going to go on universal credit, those are the places you can do. If we could streamline the application process, that would be good. One of the advantages of a loan shark, in inverted commas, is it's very easy to get a loan. And sometimes if you go through another process, it's longer. So if we can streamline the process and being responsible, and that's not handing out money willy-nilly, but trying to streamline, that would help. And trying to find out whether we can support tenants for poor credit histories. The thing I would say is I don't think necessarily every single tenant who's got a problem should be pointed in this way. Some tenants would actually need far more financial support than actually just handing them, directing them to a loaner, to a lender. And finally, like any other project, you just need to monitor it and making sure what the impact is and know what those impacts are going to be. So approach it like you would do any successful partnership: commitment, accountability, transparency, and over to the next speakers, please.
Thank you very much, Maggie. There is clearly a lot of good practice already out there. Excuse me, and a lot more learning that organizations can do where they've got schemes in place or are considering putting schemes in place. And I'm sure that the report that's launched later on today will help facilitate that. We did have a question in the Q&A about hashtag for this event, for those who'd like to tweet or post elsewhere on social media, Instagram, wherever. If you haven't seen it and you would like to make use of it on social media, which we positively encourage, we're going with hashtag affordable credit F4ACT, F4A as in fair for all, and CT as in Campbell Tickell. So hashtag affordable credit F4A CT, please get tweeting, and otherwise get posting questions. And while you're doing that, I'd like to introduce Stephanie Noyce, who is going to provide a case study. Stephanie is Head of Financial and Digital Inclusion at Clarion Futures, which is part of Clarion Group, the largest housing association in the country. And she's worked in those sorts of roles at Clarion for around 12 years. Stephanie, over to you.
Thank you, Greg. You stole my opening line there. So you saved me 30 seconds. Thank you. So as Greg said, I'm Head of Money and Digital at Clarion Futures, which is part of the Clarion Group. And Clarion and its predecessors, Circle and Affinity Sutton, have got a really long-standing history of working with credit unions. And that relationship certainly predates my time with the organisation, and I've been with the group for 12 years. And both Circle and Affinity built those initial credit union relationships for very similar reasons. And Ria touched on the same reasons that we're part of that relationship today. We know that our tenants are often living in poverty. We know that they're at high risk of unscrupulous lending. And certainly when I started working in this field, they also had pretty limited options around transactional banking and savings accounts, as well as about that loan issue that we still see today. Aspects of that, I think, are worse today than they were 12, 15 years ago when I started working in the field. Our latest resident research shows that 15% of our residents go without food because they can't afford it. And that number's even higher in the 18 to 34 age group. We know that 15% run out of money by the end of the month, and there's a further 29% only have enough money for the essentials. So these figures really tie very, very closely to ones that you were referring to. And our data also shows us that a quarter of our residents borrow money to pay for essentials. Now that rises to 38% when we look at the under 34 age group. So it's a massive proportion of residents. And that problem hasn't disappeared, say, over the last 12 to 15 years, definitely not. So our work with credit unions sits alongside a range of in-house and outsourced services which complement each other. And we want those services to tackle the root causes of that poverty and those financial difficulties, rather than just focusing on the symptoms. So that package covers, money guidance. We've got debt advice, we've got employment and training support, we've got digital inclusion support, all backed up with a credit union offer that's available for all residents. Now, those services are often packaged together to meet the needs of very specific groups. So that might be care leavers, or it might be residents newly transitioning onto universal credit. So they access the same services, but we package them together in a way that are particularly attractive to that group. And we actually do outbound proactive work to engage those particular groups of tenants. So going back to that historical context around our work with credit unions, coincidentally, both Circle and Affinity Sutton took the same path. Both chose to procure a single credit union to serve our residents and staff right across our respective delivery areas. And to give that some context, today Clarion works across about 170 local authorities, and we've got offices right across England. And both organisations wanted to work with a credit union rather than a CDFI, because at that point, I'm talking 8-9 years ago, the range of services available from a credit union was really important. That context may well have changed now. So in 2013, we commissioned a piece of research to look at how we could have a credit union service or a national banking service that all our residents and staff could access. And we needed to work with more than 60 credit unions to cover the bulk of our stock. And actually, we wouldn't be able to work with enough credit unions to cover all of our stock. So that just wasn't feasible. So we took the decision to work with just one national banking partner. And right from the start, we were clear that we would continue to work with local credit unions where there was a need and where we had a high stock number or where there was a particular issue. But that having that national offer would mean that all of our residents, no matter where they lived, would have an equitable service. And it also meant that we could offer savings through payroll for all of our staff, no matter where their office was. So from that initial piece of research, we also knew that the scaling up and the potential move away from a traditional face-to-face offering to an online or telephone-based offering would present a challenge to some credit unions. So we actually invested £150,000 over 3 years towards capacity building and investment in infrastructure. So we envisaged that would be used for things like website development, telephony, additional staff, those sorts of things. And actually we let the organisations that tendered for that piece of work tell us what they needed, where they needed that capacity building. And of course, that investment supported all the credit union customers, not just our customers. And it was an investment for long-term support for that credit union. So by coincidence, Affinity Sutton and Circle both tendered for the National Credit Union offer at around the same time. And we both selected, again, by complete coincidence, to work with Leeds Credit Union. That relationship continued through the merger between those two housing associations, and it continues to this day. We've got around 2,000 resident members. They've got about £100,000 worth of savings in the credit union between them. And there's been just under 2,000 loans made to date, worth about £1.2 million to residents. We also have about 1 in 4 staff members are a member of the credit union. Some of those are doing payroll savings, some of those will access loans, some will access both, indeed. So the partnership has grown and changed over time. And in more recent years, the financial commitment has been around supporting specialist services or specialist campaigns for our residents. So we started off with an investment in the business. Then we've worked through doing a series of work that just focus on support for our residents. And more recently, the most noticeable change in the relationship and the working partnership has been because of Clarion's inability to promote the credit union directly to residents. Now, changes in data protection legislation has meant that we haven't been able to do the campaigning work with residents that we have done in the past. And the team at Leeds have been incredibly patient with us through that. You know, we were in a position where 50 to 60 tenants a month were signing up as new members, and we now get a handful. And until we've worked through our own legal and legitimate interest processes, that number's going to remain subdued. So it's very frustrating for both sides, but we still continue to work together. And our aspiration absolutely is to get back to where we were. So to sum up, to me, the reason the partnership's been successful is that Leeds and Clarion have really worked together. And that's right across the board. That's at all levels. So there's been real collaboration and understanding. So throughout the 8 years, at an operational level, there's been regular meetings between managers and officers to understand the two businesses and to look at how we can keep working together. And at least once a year at a senior level, the organisations get together. And those are often very focused discussions, but they're also often very broad discussions. So we talk about what our priorities are, what our challenges are, what opportunities there are coming up in the future, what our worries are, so that we've really begun to learn about how our organisations differ, but with a trust and an understanding that what's at our hearts is the customers and how we can both best support that same customer group. And that to me is what's absolutely made the relationship work well and what's made it last so long.
Great, thank you thanks very much, Stephanie. That's been a really valuable lesson in how how one can engage effectively. Obviously, Clarion is a huge national organisation, but there are many lessons from what Stephanie's been talking about, and as you'll see in the report that's published later on today, where other organisations of all scales can get involved. Just before we move over to James, Zena, you're in a position to share the results of poll number 1. Very close to an even split between those attending, and we have over 120 people here between those whose organisations are involved in affordable credit partnerships and those that aren't. That's really interesting. So undoubtedly a lot of learning in the virtual room, as well as opportunities for people to go at. Right, let me hand over very quickly now to James Wilkinson. James is going to give us the other case study from the community finance perspective. James is, as you can see from the slide, interim chief executive and head of lending at the Fair4You organisation. He's been at Fair4You for around 2.5 years, and he previously worked in credit risk in banking. James, over to you.
That's all correct, apart from I'm no longer the interim CEO. Simon Dukes joined us about a month ago, so I have reverted back to role as head of lending and credit risk. And as you said, yes, previously worked in credit risk at Lloyds Bank, Coventry Building Society and Secure Trust Bank. So a bit of background here. So Fair4You was set up as an alternative to high cost lending, helping the 14 million people or so who were denied access to mainstream credit. As Ria mentioned earlier, the landscape has changed in an incredibly short space of time as well. The reduction in high cost short-term credit, payday lenders, rent-to-own, doorstep as a result of regulation and pandemic has been replaced with something of a regulated borrowing vacuum at the moment. There's obviously the rise of buy now, pay later, but more worryingly, as mentioned, loan sharks coming to the fore to serve the demand in the sector. So next slide. A bit about Fair4You. Started trading in 2016, backed by a number of social investors and owned by Fair4You, the charity, both of which keep us firmly on mission to improve lives through our lending. We're currently 30 members of staff, I think. We're based in the Midlands, but we serve the whole of the UK via our online offering. Now a bit about there we go. Our lending, we have a debtor creditor supplier structure. So the customer comes onto our website and then they're diverted off to the partner website where they choose the product. Then they come back to us, we make the lending decision, and if approved, the goods are normally delivered within 5 to 7 working days. We saw significant growth in the last 18 months, as mentioned before. High cost credit lending in the subprime sector reduced markedly, and as more people are struggling to juggle their finances following the impact of the pandemic, furlough scheme, end of universal credit, fuel and grocery costs, etc. Despite all these challenges, we've demonstrated we can lend safely and responsibly in the sector through our knowledge and creation of really bespoke credit risk strategy and an empathetic approach to collections. So a bit more about our lending on the next slide. As you can see here on the highlights, we have a very flexible repayment structure. So repayments can be amended if the customer is having an income shock, which we see all too often. Overpayment is also welcomed. There's no late fees. The interest rate is as low as we can go to remain a sustainable entity. And as you can see on the example on the right hand side, so a £400 washing machine, there's less than £100 interest charged in a 12-month term, and that is significantly less than Perfect Home, who actually are no longer lending to new customers, and any regulated cash loan provider. So next slide is a bit about our partners. So Whirlpool are our main partner. I think 85 to 90% of our first loans are for white goods. Our returning customers gain more access to more quality of living products, so computers, TVs, electricals. We have a revolving credit shopping card for our returning customers, which has a £350 credit limit. It acts a bit like a credit card. We're working on adding more retailers to that list. Habitat and Currys, I believe, are imminent. And finally, we have a pilot with Iceland for what's called the Food Club, which is a sort of micro revolving credit loans to help families put meal on the table during school holidays where they struggle to make ends meet. Other partnerships we've worked on is mainly around signposting. So there's a couple of local authorities, Glasgow and one of the London boroughs, and housing associations. Legal and General, we do some signposting with their welcome letter to new tenants. And as mentioned by Maggie earlier, the Barnet Homes also do signposting for us. Next slide is just a bit about customer recognition. I think this is missing winner 2021 as well for Firm of the Year. But the Consumer Credit Awards are important to us because it is voted for by our customers, and that's with the Trustpilot scores, which we constantly keep track of. Which is currently, I think, 4.5 out of 5, do show that we are providing the services that our customers want. The next slide is a bit about social impact. So we do regular social impact reporting as demanded by the charity and by our investors. The last one was September 2020 by the Centre for Responsible Credit. And what it shows here is our customers are able to leave high cost credit and are better able to manage their finances as they broke that high cost credit cycle. And health is another big one, although it can be hard to measure. It was clearly evident there were improvements in quality of living, reduced physical and mental health issues are all there on the report. And finally, so what's next? So we obviously have two big barriers, one being investment. So we are a sustainable business, but we're only really scratching the surface of addressing that void in the whole sector, and particularly related to today's session, awareness. If we can have more partners and advocates for our services, it reduces our cost to reach customers, and particularly with housing associations, we know we're reaching a demographic that are more likely to need our help. That's all for me. Chris's contacts are on there, so you can get in touch to him. He's our commercial manager. He's on leave today, which is why he got stuck with me. But back to you, Greg.
Thanks very much, James. And as with the other speakers, there is a lot to go at there. The time remains tight, but we're more or less on schedule. So I'm going to go over now to Lauren from Fair4All, and Lauren is going to talk about Fair4All's plans to implement the guidance and establish partnerships. Lauren is Head of Markets, Consumer Insights and Product Design. As you can see, she joined Fair4All earlier this year after spending, I think, around 8 years at Aviva in various roles, particularly focusing on customer engagement, digital and marketing. Lauren, it's all yours.
Yeah, thanks so much, Greg, and thanks everyone. It's really, as others have said, great to see the engagement and great to hear from other speakers who've got a lot more, real world experience in this space. I think the first thing I'd say is listening to speakers today, we are really skimming the surface of some of the great content that's in the report. So as that becomes available, I really urge you to take that away, read it, share it. I think it really brings a lot of this to life, and no doubt we'll get some kind of questions and some considerations going within your organisations. And I think what the report really tells us, and what stood out to me when I was reading it, is we have a really clear opportunity to act and to deliver partnerships that are going to support people in really vulnerable circumstances. I think if we move on to the next slide, what I saw is we've got the immediate need of tenants, especially with the increase in the kind of cost of living crisis that we know is happening right now. The benefits to housing associations in terms of kind of tackling those rent arrears and those kind of costs to serve, and and managing the evictions and bringing some of those costs down while also increasing financial resilience of tenants. And then real growth opportunities for affordable credit providers. At the Fair4All Finance side, we're all about increasing access to affordable credit and working with providers in that space. So bringing these three things together, it kind of makes sense that we should be taking action here and doing something to deliver for tenants and for housing associations and providers. But what we think is we know that great partnerships don't happen by accident. It's not enough to kind of just read the reports and think about this. This is something that is going to take action to get it to succeed. So it's going to take commitment between community finance providers and housing associations. It's going to take focused resource plans, being really clear on what your proposition is for tenants and for customers, and monitoring that performance, so where things aren't working and what might need to change to kind of really get the most out of your relationships and your partnerships, and making sure that's set up over time. I noticed a comment came in about customers and segmenting customers to make this work. Yeah, I think that's a great shout. I think housing associations, the employees who engage with customers day to day and kind of speak to them firsthand, it'd be great to see them almost have the ability to monitor where customers could benefit from affordable credit, and almost look for those quite subtle triggers in behaviours and what people are saying and what they're not saying that make you think, actually, this is someone here who maybe would benefit from that kind of referral into community finance, and then starting to be able to segment that on a broader level once you've got those, like, what are those quite subtle customer triggers to look for. So when you're thinking about setting up these partnerships, or, we saw 50% of attendees on the call have got partnerships like this already. Maybe it's that you're thinking about refreshing existing ones to kind of make sure they're really successful for all the organisations involved. This is going to take kind of resource and commitment and some work to get there. And what's great about the reports, when you'll see when it comes through, is there's quite a detailed how-to guide as an appendix in the report, which for a lot of organisations I'm sure will be enough to kind of get moving and get mobilised and start taking some of those actions to really deliver a great partnership. But what we'll be doing at Fair4All as our role in increasing access to fair and affordable products is we do want to support firms in delivering these partnerships. So I think if we move on one, what we're looking to do is support up to 3 partnerships and kind of are setting up new relationships like this. And we'll be looking to do this from around Q2 next year, just to line up with some existing commitments we've got. And we'll be looking for partnerships where organisations are already committed to delivery, including kind of thinking about the resourcing requirements you need, and either having that already or setting out what that needs and what that needs to look like. So there is that kind of commitment to deliver something that's really going to work. It could be across any of the 8 models that Maggie kind of touched on earlier, and there's more detail on in the report. And ideally working with tenants to design what's the best model and what's the best solution, and kind of being really inclusive in that design process to make sure you're designing something that's going to be really valuable. And we'll also be asking the kind of firms that we work with to probably maybe at the back end of next year, kind of be willing to share those learnings and best practices to delivery. I think, Stephanie, you touched on some of the things that had worked well and then what had been challenges. I think that's just really valuable in being open and sharing those experiences. And that's what we'll be looking to do. We'll be looking to kind of help firms deliver, and then also share those learnings more widely for the sector to help others who are on maybe an earlier stage of the journey. So what we'll do is, along with the recording of this session and the report that comes out, there will be an expression of interest link. It's just a short form to kind of give some information about your organisation, where you're at with thinking about these kind of partnerships, and say that this is something you might want to be involved in from Q2 next year. And that's it from me. I'll go back to you, Greg. Thanks very much.
Great, thanks very much, Lauren, and quite an ambitious programme over the coming period, which will be excellent to see real progress with. Okay, we've got about 20 minutes for available to deal with questions. But before we go to those. Zena, Rihanna, are you in a position to share the results of poll number 2, please? Right, I hope everybody can see that. So the biggest challenge to be overcome perhaps unsurprisingly, 40% saying that more awareness is needed about the potential benefit, and hopefully this morning and indeed the report, when you get to see that later, we'll be able to make a dent in that. But resources and funding identified by a quarter of the respondents, around a fifth saying better understanding needed of how to run successful partnership. So that kind of relates to the more awareness aspect, and then a limited number, about one in 6, 1 in 7, saying it's the issue is around regulation, could be around regulation. So some useful and interesting results there. So we've got various questions in the Q&A box, some of which have been helpfully answered already, especially by Ria. Thank you, Ria. And I would like to go through some of the other ones that haven't been answered. So we've got a question from Liam Carlisle. In 2013, the government transferred DWP social fund to local authorities, and his council, which I think is Lewisham, delivered this until 2021. Can CT and Fair4All look at the opportunity to work with local authorities, credit unions and housing associations to develop an emergency financial service through these partners? Maggie, do you want to?
Yeah, I just wanted to say, when we started the project, it actually very much focused on housing associations. And the reason for that was because it was approached as a research project. We wanted to be able to have access to and all housing associations, which obviously we do have, and we carried it out for that. As we were doing it, because actually I do a lot of work with local authorities, that's one of my main things, and I realized from the work all over the country how much this is needed and how social housing tenants across the board and local authority tenants would actually require that. So personally, I think it would be great to do. I think it needs to be planned to see how it would work. But I think absolutely it's something that we should be doing, because, you know, when we're talking about the figures about the tenants, social housing tenants who are in difficulty, it's across the board. It isn't just for housing associations. So I think it would be quite good if we were able to do that, but we need to talk with Fair4All to see how if we could expand that.
Good, thank you. Gordon Keenan has asked a question. 2,000 members borrowing from Leeds represents approximately 1.5% of Clarion's tenants. And while there will undoubtedly be other sources of in terms of credit unions and CDFIs and welfare support, there are a lot of other residents who aren't covered. So I think it's two questions, and perhaps Steph, if I go to you first, and then maybe if I go to Lauren afterwards. The other aspect of the question is, do the very large housing associations, Clarion are obviously doing a lot, nonetheless, is there more that other large housing associations could be doing, if you like, to pull their weight? Steph, do you want to go first?
Yeah, absolutely. And Gordon, I absolutely agree. I mean, 1.5% is a really small proportion of our tenant base, and actually it could be phenomenally higher. I'm not sure that the issue, certainly for us, is about resource or investment. For us, it's been about this not being classed as a core service, and so it's not something that we can actively promote to residents at the moment. We are trying to solve that, and we've got a team who have been spending a considerable amount of time trying to undo that. So we were getting much higher engagement rates, say 50 to 60 new members per month, when we could do regular promotion. And we were doing things like texting and email. We didn't do leaflet drops anymore because they weren't particularly successful, but there was quite, you know, a coordinated and long-term campaign. And that's where we need to get back to, and that's where our aim is. So that for us is the biggest challenge, rather than it being more of a sort of an investment issue. But hopefully if we can go back to that, we can get that number higher.
Yeah, now should I come in? I think that I was just looking at thinking back to the poll where I was saying, 24% resources and funding people think is a barrier. And I think that the Clarion and Leeds relationships had the benefit of that funding and support. But I think something that's maybe across the sector, and I'm going to say across partnerships across the sector, because we see this in payroll as well, is almost really clear commitment and accountability for these routes to market and these relationships. So who's how do we monitor performance for this? Who's looking to say, okay, is it up or down? If it's down, what action do we take to reach more customers? It's quite almost a commercial, from a very kind of black and white commercial perspective. If you treat it as how do we reach more customers in this channel? What marketing are we putting into there? What relationships do we need to cultivate? Who's having the face-to-face contact with the tenants and the customers and those conversations? And how do we improve performance overall? Is going to be really key across all of these partnerships. And I think I'm looking at should we be pushing for regulatory rule change? I think is one to explore as we go through the process. I think it's something that I'm not hearing is top of mind given the FCA exemption, but it might be something that comes up as we go through the process of working with organisations to kind of deliver more partnerships.
Good, thank you. It's a question from Piers Williamson. What proportion of the financial needs of Clarion's tenants can be met by Leeds Credit Union? Which I think is an interesting question. I mean, perhaps this is a broader. Okay, one could focus it on Leeds Credit Union, but perhaps this is a broader question about the capacity of the credit union and the CDFI sector more generally. James, I wonder if you'd be in a position to tackle that one.
Oh God, that's a tricky one, Greg. I mean, we have a nationwide offering, so we cover all aspects, and we're a member of Responsible Finance, who also have plenty of representation in the sector. But yeah, really don't know whether they are mainly cash lender providers. So we have a very unique offering because we are for bespoke items and have those retail partnerships. But yeah, tricky one. Sorry, Greg, can't really answer that.
Okay, no, it's. I mean, I think it's the sort of question that no doubt Fair4All will want to give some consideration to over the coming period, because of course the more these schemes are a success, the more they grow, the greater the potential demand, and also the greater the potential risks. So undoubtedly areas for Fair4All to think about. I mean, Ria, I don't know whether you'd have any comment on that aspect.
I think, in actual fact, just on that, I've just replied to another question around when you're starting to get into kind of some of these details and thinking through scenarios and that sort of thing. I wonder if there is something that we can go away and think about, because that barriers poll came up, didn't it? There was a large one to me. It was about, actually, let's take a step back and go, but let's rehearse what the benefits are from this from the first place. Let's go back to first principles. What is the benefit to everybody in the first place? And I think there's a piece of work, and I think it comes out really well in the report, actually, from that. Have a look at the report. And then I think there's some kind of almost becoming comfortable with the scenarios and being comfortable then with the details of things. And I think there's something that was perhaps a discussion for us to take away about, actually, how could we support that? Of not necessarily doing it for organisations, because every organisation has different risk appetites and all sorts of what is going to be appropriate for them. But maybe there is something a bit more about helping some more awareness and scenario planning around some of this.
Good, thank you. Lisa Pickard's asked a question about how many people are found not to be eligible and what the process is for declines. she talks about working on a Fair for All declines project. I wonder who would be in a position to talk about declines and how to handle those.
I was just typing an answer back, so shall I?
Yes,
shall I
please
pick up
go,
on that?
Go for it, Lauren. Thank you.
I don't have the kind of percentage eligibility and percentage declines data to hand. So what I was kind of saying was, we know that when a customer is declined, usually, and especially if they're in that moment of immediate need, so where we're talking about, 7 kids, washing machine's broken, I need an immediate solution. Oh, I've been declined for loan for, affordability, or, kind of whatever other reason that they might have been declined for. Kind of after what Lisa's referring to is around how do you reduce the risk of that customer then going to illegal money lending or high cost credit? Just because customer's been declined, the need doesn't go away. The need for that loan doesn't go away. So how can we provide the most support for people in those real kind of extreme moments of vulnerability? So I think more to come on that. I don't have an immediate solution other than we know a lot of the community finance providers we work with do have wraparound support and will refer off to debt advice, or might refer off to kind of money and pension service, money helper type tools. So we're kind of really keen that a lot of the community finance firms we work with are providing that additional support, which isn't in the advice side, but is on that. Here's we're recognizing that a customer is in a difficult situation. They're trying to provide the best support they can, even if it's not a loan at that moment in time.
Good, thank you. I think that's probably also picked up Philip Cole's question, which concerns due diligence before lending. But is there anything you'd like to add on that, Lauren?
So I'm sorry, I was skimming through the other question. So I'm just
signposting. Speaking as a credit union, we're very careful about due diligence before lending, and we'll signpost. Excuse me, where appropriate, if a loan is approved or not, we then keep close contact with everyone in arrears, and we'll signpost again to support services where appropriate.
Yeah, I think that's just a good example of kind of what we were talking about. How do we, and how community finance providers are supporting in the kind of the broadest sense, not just a yes or no, here's some money, but the broader view of what's good from a customer's well-being and financial resilience point of view, which is why I think these partnerships have such a good opportunity to support customers.
Thank you. Carol McHarg's talking about experience of training and enabling housing officers to sign up new members on our behalf. Is this a way of increasing uptake? Steph, any comments from you on that one?
Yeah, and actually it's an approach that we've used in the past, but we again found we spent so much time and resource, both from Clarion Futures perspective and from the credit union's perspective. It took such a lot of time for actually a relatively small return, because the types of residents that those housing officers and other frontline teams were often coming across, it wasn't the right time or the right situation to be having the conversations with about, would a credit union be helpful to you? So we still found it just meant we still touched such a tip of the iceberg. It's the large marketing campaigns and the consistent marketing campaigns around, affordable loan options, around savings for Christmas, around all those sorts of things that could go out en masse to residents, had far bigger impact because it touched a far greater number of residents. That's where we began to get really big traction. And obviously it's quite an efficient way of raising awareness as well. And that, so that's really where we need to get back to. The consistency actually is really important. We found if we were doing a marketing campaign sort of once a quarter, we didn't get very good take up, but doing something, once a month, even more regularly than that, it got the right message in front of the right resident at the right time. And that's what we needed to do. We can't say something today and in 3 months' time a resident remember that, oh no, I had something about this 3 months ago. I know where I can go and apply for a loan that might be a better alternative. it's that consistency that we found was really important. So yeah, we have given that a go, but it really for us wasn't that successful.
Okay, right. Thank you. Well, that's at least realistic and practical. Let's move on to another topic. Annabelle Palmer's asked about the GDPR challenge that many housing associations are facing. James, I wonder whether that's something that you'd be in a position to tackle.
Only that we had, I share those concerns. We had a really positive discussions a few years ago with a housing association, and they were keen to set up an indemnified loan scheme. And it was all really encouraging, but we fell over at the GDPR hurdle as well, because they wanted to know how their tenants, which tenants were falling off plan that we were looking like we were going to have to provision for. And we never solved that problem. So again, a spot of realism there. If that was an idea around collaboration, there needs to be a way to overcome that, or just have that trust in the relationship that actually we're having to provision for some of these. They are falling off plan, but we can't disclose which tenants they are, only that it's happened. So a tricky one to overcome.
Indeed. Steph, what's your experience? How do you go about this one?
As far as the sort of the information on individual loans or individual credit union members that are also residents, we've been very fortunate that we've always been very open-minded about it, in that actually what's important to us and what matters to us is how many are signing up, what are the products and services they're signing up to, rather than individual data. Now, obviously, we track things like default rates and those kinds of things because it's really insightful information, and it gives us a really helpful temperature check on what's going, what life is like for residents. It's another source of information, so we can see, and they're interesting discussion points with our credit union partners as well. For us, and Annabelle, I don't know if this is where your question is coming from. For us, the bigger issue is we can no longer market the partnership. We can no longer do campaigns that send out an email or a text message or a leaflet or whatever it might be to a group of residents to say, actually, we have this partnership. We're no longer allowed to do that. Now, some associations do. They consider it a manageable risk, and other organisations don't. But that's where it's impacted our work more.
Thank you. I think we all recognise that there are all sorts of different challenges, and conducting this study and issuing this report, addressing case studies and so on, is not the end of it. And as of course, as we'll have heard from Lauren earlier, there is a significant programme to take forward these issues with different audiences to address the barriers that there are that can be in the shorter term, and seek to tackle various ones in the long term. I'm conscious of the time, and we gave a commitment that we would finish at 11:15. So I think we might need to leave some of the final questions, but there'll be plenty of opportunity to engage afterwards, and everybody will receive details of. Following this event, everybody will receive details of the report with links to access that, and where to go for further information, discussion, and engagement. So before finishing, can I hand over first to Maggie for any sort of final thoughts?
And then on to Ria. Okay, first of all, I think what the report has done is actually highlighted, well, we actually knew that there was a need, but it's highlighted the need and the range of and the scope of it. What I think is really great about it is actually it's a very practical report. As somebody who deals a lot with strategies, they're no good unless you've got an implementation and action plan at the end of it. So there's a lot of actually the reasoning behind it, and you can see the thought And so, and it's a well-written report, and it shows a route that what you can do, but it really has to be very practical. And the whole idea, and also it's very useful to have all these questions that have been asked, which actually quite highlight. Sometimes when you do these webinars, actually you learn much more as someone who's actually been involved from the beginning, which is actually great. So I think it's a good start. It has to actually be expanded and to actually make it a reality so that we can support more residents. So I'm just going to hand over now to Ria to finish off. Okay, thanks.
Thanks, Maggie. I think for me there are kind of a couple of things that I'd really like just to leave the audience with. I think credit is a reality for people, and therefore I think, you know, we can't shy away from that. This is a really, really big, significant thing that we need to make sure that affordable credit is part of an offer and accessible to people wherever we possibly can do. And there was lots of ideas in the chat about even, you know, touch points and just ways that we'll be able to do that. So I think credit is a reality in people's lives is the first one. I think the other one is looking at these partnerships as an investment. They're an investment for your residents, and they're an investment for your businesses as well. And I have been pushing for years and years and years and years and years that this stuff is core activity for housing associations. Their social purpose, their places in communities, means that financial well-being is absolutely key. It is a cornerstone. And I think the landlord relationship is very, very special that they have with communities and residents. I would love to be able to see this is driven as core activity. It's driven because it makes sense for business. It's driven because it makes sense for individuals and for our society as well. So I think they're kind of the two key things that I'd like to leave with.
Great, thank you very much. Thank you very much, Ria. And indeed, thank you to all our panelists. Really appreciate your time. Thank you to all of those who've attended. Still 110 on here at the end, which I think is an indication that there is considerable interest out there. So thank you all very much, and have a good day, and let's get out there building those partnerships.